is next is in May 2024, so Q2 2024 at the 1st of May FOMC meeting. That will be the question we will tackle this week. Welcome to our weekly report. I'm Roman Kyler, Exo Capital founder. We're going to have a look to datas. Firstly, let's jump into GXY first. This week we had a pretty good growing week. We went from 104 to the current 105, as you can see. So about 1.4% increase. This is without counting the large increase we had on last Friday. Basically the USD is in like we can read here. It's in a gain period since 8 weeks. So we're gonna have a look to this. Of course, about the VIX, we are at current 13.8 points. On a monthly basis, we are on a drop, and on a weekly basis, we kind of increased a little. Our 2-year bond is at the moment at 4.995, so an increase this week, where we went from on Tuesday, because of course we had Labor Day this Monday, we went from 4.9 to almost 5% at the moment. So as you can see, and if you can remember, we are in a uptrend on the rates, especially if you look at the 5 years. It's obvious. For the S&P, we are at 44.57 points. We went from a higher points last week, where we were at 45.14 at the closing, 45.15 at the closing on Friday. We are today at 44.57. So we went down by about 1.6%. If we look deeper in the chart, we are here in the daily basis. We can see that, such as we said last Saturday, we kind of reach this resistance. So it's it's kind of our top resistance related to other highs and 50% zones. I will repeat it just after, when we'll be on a weekly. But we dropped on Wednesday, especially, might be due to the data. We'll also have a look after, but we are now at this point. So on the RSI, we didn't we confirmed the breach, if I can say, on a daily basis of the RSI support trend, where we went down. We breached it on beginning of August. We tried it back 1 month later, and we didn't succeed. We didn't succeed. We didn't made it. We didn't make it, if I can say. So on the weekly basis, if we look, we're gonna have a more global view. We can see that, if you remember that zone, it's the 50% of that last big zone of the last huge up momentum. If we remember, January 2022, our last all-time high, which is about 48.20 points. We'll be looking at the next weeks, but basically we did confirm, if I can say, that the breach is not here. So I would rather say we didn't confirm the breach of our resistance. So we are now looking at next week. We could go lower than that, or test again our resistance on the upper trend. So about the data, why it is interesting is because we had green data. So if you remember, when it's green, it's basically against the Fed, and if it's red, it's in favor of the Fed because they want kind of they want to slow the inflation, and that's their mandate. That's what they are looking at. This week on Wednesday, we had purchasing manager numbers higher than the forecast, and unemployment claims lower than the forecast. So that's bullish for the Fed. Might be one of the reasons we had this drop on the Wednesday. We'll definitely be looking at this data because it influences a lot the rate policy, and it's the title of the video. We'll discuss more later in our next screen on the probabilities of hike, ease, or same current rates. For next week, the main event will be the CPI numbers. We already got the forecast, which is 3.6, pretty high. This is also one of the data that made the market kind of drop because it's pretty high, and after the forecast was released, we directly seen an increase in the probability of a hike, not for next FOMC in September, but the one in November. So for next week, CPI numbers, we'll be looking at also the producer price numbers and the consumer price month to month, both of them. The forecasts are 0.2 for the consumer and 0.2 for the producer. The retail sales, same thing. We will be expecting maybe a higher number than the actual like we had last month. So we're gonna look at that, and we will be also looking at our weekly unemployment claims to see if the numbers are still lower than the actuals. The forecast is 225,000, so lower than the previous forecast. So we'll see if we are still with a big difference, not that big, but it's still important. On Friday, we'll have just the preliminary consumer sentiments. So not that important, but we will be able to check the Empire State Manufacturing Index, which were at minus 19% on the actual last August, and now the forecast is minus 10. So we're gonna see what is the number we're gonna have this week. So the next 2 weeks are gonna be very interesting. Next week with the CPI, and the week after, of course, on the 20th of September, we'll have the FOMC. So let's jump into that. The FOMC in 11 days from now. If we look at the 20th of September chart, 92% chance of no change and only 8% of a hike. We are actually lower than past week. It's because of what I've just said. Last week we kind of have data saying the Fed will not need to hike again, but this week we had counter information, so that's why we dropped by 2 points. If we look, so like I said in the title, in May, we will see directly that the probability for ease, it's 61%, while not last week, but the week before, the ease was predicted for March. So we kind of have a confirmation of what I've said last week, in the sense that the probability for ease has been moved, if we can say, from March to May meeting. All right, so we'll be looking for next FOMC at same hike on November. That's the interesting part, where for a no change probability, the number went from 65% last week, if you remember, to 53% now. So it dropped by more than 10%, while the hike probability increased by 10%. So next week, with the CPI numbers and of course Powell's speech on the 20th of September will give us more precise indications on that. I bet the tendency will get more clear at that time. But for now, as you can see, basically the probability of a hike has greatly increased for November. And like I was saying, in March, we are no longer with the probability of ease, but more with the probability of a no change from current rates. So would mean a cut if we increase at the moment, okay, but would not if we don't increase. So we'll have more information next week on that. It will be more interesting to discuss this later. But basically, the next is now predicted for May rather than March. On the Fed side, what we want to have a look is their debt, which is almost reaching $33 trillion. Okay, so that's a lot of money. And just to have a look to the like evolution of that, if I can say, let's have a look 3 months ago, like Joe Brown did in his video Erisy Financial. On his channel Erisy Financial, which I advise. On the 31st of May, sorry, we were at 31.5 trillion. Okay, so I repeat myself, on the 31st of May, so at the end of May, we were at 31.5, let's say, trillion debt. At the moment, we are at 33 trillions. Okay, so that's an increase by 1.5 trillions in only 90 days. That's a huge increase. The total debt is almost like it's a real burden. And when we look at that chart on the St. Louis Fed website, we can see the interest payments, which I talked about in a previous video, that are almost reaching $1 trillion payments per year. I mean, it's an increase by almost two. I mean, it is an increase by two if you take it from 2016. Okay, so the interest payments is now almost the first allocation of funds for the US government. Why? What does it mean? It means that we definitely gonna see a drop in the rates, because it's not sustainable for the US government, those rates that high, and it might lead to systemic issues where the Fed might have to change, the Congress might have to change the mandate of the Fed, where their mandate will not be only to control jobs, like the lowest as possible, and the inflation, but more finance the US government. So that's what Joel Brown explained in his video on his channel Erisy Financial. You can have a look at it. On my side, will be the end for this week. I I will closely monitor next week's CPI numbers, and we should talk on next Saturday. Bye bye, everyone.